Good afternoon. My name is Varun Nataraj, and today we're going to step into the role of the newly elected president of Baronia. Now, as you can see on the left hand side of the slides, these are some of the factors under Baronia's background and essentially sums up the economic crisis they're in. It also mentions some factors which diminish the trust of the Baronian florin. Now, we're going to argue that restoring trust is imperative because trust is fundamentally important to money functioning in an economy. Now, McWilliams explains that money is a belief system. We believe it holds value because others believe it holds value. And further to this, Buchan states that money can only unite society when that trust exists. Now, in Baronia, it evidently does not, and we're just going to explain some of the reasons as to why it doesn't exist. Now, the brief directly points us to how a history of demonetization episodes ultimately led to Baronians losing trust in the florin. Now, a demonetization episode is essentially a forced currency change by the government, where the new units replace the old ones. It sends a clear message to Baronian people that their florin is not safe. Now, this mirrors Zimbabwe from post 2000 to 2015, where multiple demonetization episodes led to the formal abandonment of their currency, and they ended up adopting a new foreign currency entirely. So, once trust is broken in this way, similar to Zimbabwe and now Baronia, it's extremely difficult to recover. Just moving on to some compounding factors which have further diminished the trust of, further diminished Baronian people's trust in the florin. Now, whilst demonetization episodes are sudden shocks, inflation acts in the shadows, slowly and continuously eroding the buying power of the florin. As Easterly and Fisher acknowledge in their 2001 report, inflation disproportionately hurts the poor. Now, if we apply this to Baronia's situation, they're a low to middle income country. This means that majority of their citizens are going to be disproportionately hurt when there's higher than average inflation. Now, as the florin buys less and less each day, it also loses its ability to function as a store of value. And therefore, Baronians will lose another reason to trust it. They don't have reasons to trust this currency. Now, just moving on to my next point about the lacking independence between central bank and the government. Now, under the previous government, the finance minister also served as governor of the central bank. These are fundamentally different roles. The finance minister is a government official responsible for taxation, spending, national budget. The central bank governor is independent of the government, focuses solely on monetary policy, controlling inflation, protecting the currency, and controlling interest rates. Now, Cappy et al. Notes that governments have a natural preference for cheap finance from their own bank. Now, when one person occupies both roles, there's a high likelihood that they're going to prioritize the government's interests and the political interests. Now, this creates a further reason for Baronians not to trust the florin. And just moving on to my final point about lending to crony importers, we're continuing this discussion about prioritizing political interests. Now, Baronia's bank-based system mainly lends to crony importers. So crony importers are businesses whose success depends on political connections rather than productivity. This is essentially crony capitalism, but a more niche version, because they're lending specifically to crony importers. And Mishkin argues that financial systems must allocate capital to its most productive uses. Now, Baronia's system fails this test undoubtedly, because productive domestic businesses, they're starved of the credit. What essentially is happening is the money is being lent to businesses who are importing foreign goods. The money that they're being lent is just being circulated and pumped out of the economy. And because of this, how can Baronians trust this currency when the system itself is letting them down? The system is allowing money to just circulate outside of the economy rather than within Baronia. And these domestic businesses are just impacted. So hence, Baronia has no reason to trust the currency operating within this system lending to crony importers.
Hi, I'm Zain Shadeen, and I'll be discussing the implications surrounding central bank dependence and how it relates to Baronia's flawed financial system. In Baronia, there is no separation between fiscal and monetary policy. This is seen through the previous government's finance minister being the governor of the central bank. So the same authority has control of both, and there's no separation between the two. This creates a conflict of interest where the monetary policy is used to support government objectives rather than ensure long-term economic stability. Governments are often incentivized to boost spending or stimulate the economy, particularly in the short run. However, central banks are meant to focus on controlling inflation and maintaining price stability. On the right here, we have a quote from economist Alexander Young, stating how central banks that are free from government control are able to create more stability and make more credible monetary policies. Now, an implication of central bank dependence is inflation bias. So, inflation bias occurs when governments rely on central bank financing to fund their spending. This effectively increases the money supply, which leads to increased inflation if it's not matched by the economic output. A very clear historical example of this is in Weimar Germany, the hyperinflation seen there, where excessive money printing led to extreme levels of inflation, as seen in the graph over here, and ultimately their economic collapse. The image also shows like the extent of how much money they were printing at the time. Similar patterns were seen in the Confederate States during the American Civil War and post-World War One Europe. These cases show that when central banks lack the independence, inflation can become persistent and very difficult to control. These cases also allow us to come to the conclusion that Baroni's high inflation rates are in part due to the lack of separation between government and central bank. Finally, central bank dependence can lead to financial instability. Political influence may cause banks to lend money to connected individuals or unproductive projects rather than viable ones. This creates a severe moral hazard where institutions take excessive risks because they expect support. Over time, bad loans accumulate in the financial system. The Baronian central bank exhibited this behavior as it lent most of its money to crony importers, resulting in the accumulation of bad loans. A credible central bank should act as a lender of a last resort during crises. If it lacked independence, however, it may not be able to perform this role effectively, increasing the risk of a financial crisis. The reason it wouldn't be able to perform this role effectively is because all this money is going to projects that are useless and not worth the time. This quote below is from Bernie Fraser's 1994 speech, where he gives an answer as to why central bank independence is important. The brief answer to this question is that price stability is generally considered a good thing, and that an independent bank can help achieve this. Overall, central bank dependence leads to inflation, ineffective policy, and financial instability, highlighting why independence is critical for long-term economic stability.
Today I'll be talking about the monetary reform and the financial sector reform. The country is facing high inflation with low trust in its currency and the inefficiency of the financial system. So the goal here of these reforms is to restore the credibility and stabilize the economy by improving how money flows through the system. The first reform is central bank independence. Currently, the country's central bank is not independent, which means the government can influence monetary policies. This often leads to money printing and high inflation. To fix this, the central bank must be separated from government control and given a clear mandate to focus on price stability. It should be run by a professional board and make decisions without political interference. The key idea here is credibility. When people trust that the central bank will control inflation, they are more willing to save, invest, and use the local currency. So overall, this reform helps restore trust in the currency and reduce inflation expectations. The second reform is inflation targeting. This means the central bank sets a clear inflation target, for example, 2 to 4%, and uses interest rates to achieve it. If inflation is too high, the central bank raises interest rates to slow down spending. If inflation is too low, it lowers interest rates to stimulate the economy. This approach replaced older methods like controlling money supply, which proved unreliable in practice. The main benefit is that it anchors expectations. If businesses and consumers believe inflation will stay low and stable, firms won't increase prices aggressively, workers won't demand large wage increases, and this creates a stable and predictable economical environment. So overall, inflation targeting helps stabilize prices and improve confidence in the economy. The third reform focuses on fixing the financial systems by breaking crony lending. Right now, banks in the country mainly lead to politically connected businesses instead of the most productive ones. This leads to inefficiency and low growth. To fix this, several changes are needed. Firstly, establishing an independent financial regulator to oversee banks and ensure fair lending practices. Secondly, improving transparency and accountability so lending decisions are clear and not based on connections. And lastly, reduce reliance on banks by developing capital markets like bonds and stock markets. This allows firms to raise money directly from investors known as direct financing instead of relying only on banks. The key idea here is better allocation of capital. When money flows to the most productive firms, it leads to higher growth and greater efficiency in the economy.
Hi, my name is Professor Sihanat, and I'll be covering how Baronier can actually fund its long-term growth through three key areas: infrastructure financing, financial product, and fintech. Here's the big pictures. There are three pillars that work together. First, how we finance infrastructure. Second, the financial product that needs to support that. And third, how fintech can accelerate everything. Each pillar built on the last. And together, they drive productivity, investment, and economic growth. Let's get started with infrastructure. The core challenge is simple. Infrastructure is expensive and takes decades to pay off. Baronier doesn't currently have a strong system to fund that. The first solution is public-private partnership or PPP. Instead of government bearing all the costs and risks alone, private firms shares the burden. This makes large projects far more achievable. Second, Baronier can issue infrastructure bond. This lets the government raise money directly from investors for specific projects, roads, energy system, hospital, without relying solely on the budget. Third, attracting foreign direct investment bring in not just capital, but expertise. International firms will have built this infrastructure before, and their knowledge matter as much as there's money. Finally, working with international institutions like World Bank provide credibility alongside funding, which helps attract further private investment. Financial product. But having project to fund isn't enough. You also need the right financial product to support them. Take long-term loans. A highway doesn't pay itself in 5 years. Baronier needs financing structure that match the actual timeline of infrastructure. We're talking 20 to 30 years. Developing a corporate bond market is also critical. Right now, firms have limited ways to raise large amount of capital. Functioning bonds market change that. It depends Baronier financial system and make large-scale investment more efficient. And risk-sharing tools, things like insurance, production, and government guarantees make investors more willing to participate. When the downside is managed, more capital flows in. Now, fintech. This is often overlooked in infrastructure discussion, but it plays a big role. Digital payment makes transaction faster and reduce friction across the whole economy. Mobile banking is particularly powerful in Moroni. It brings financial service to area where traditional banks simply doesn't exist. Alternative financing tool like crowdfunding opens up a new way to fund smaller local projects that might not qualify for traditional financing. And perhaps most importantly, fintech improve transparency. Digital trails makes it much harder to hide corruption. For a country like Baronia, where corruption is known barrier to investment, this is genuinely significant. In conclusion, infrastructure financing give Baronia the foundation, financial product, give investor the tools they need, and fintech make the whole system faster, more inclusive, and more trustworthy. Together, these three pillars create a financial system capable of supporting real, long-term economic growth, higher productivity, more investment, and a stronger economy for Baronia. These are my reference. Thank you for listening.
Hey, I'm Ibrahim Iqbal, and I'm going to be wrapping up today's presentation. Previous speakers have already covered why people in Baronia don't trust the florin, what relying on the central bank has cost them, and what reforms are needed. This next section is focusing on the final piece, what actually needs to be in place for those reforms to stick, because at the end of the day, policy without strong institutions is just talk. And in Baronia, broken promises are exactly what got them into this situation. Baronia needs 4 institutional pillars working together: an independent financial regulator, the rule of law, a lender of last resort, and fiscal discipline. These aren't optional extras. They are the conditions under which trust in money and finance can be rebuilt. First step is an independent financial regulator. Right now, Baronia's financial system isn't allocating capital properly. Instead of funding productive businesses, banks are lending to politically connected importers. That's a big reason why growth is so weak. What they need is a regulator that's actually independent with real authority, overseeing lending standards, enforcing transparency, and making sure credit decisions are based on merit and not connections. If you look at the data, it's pretty clear countries with low independence, like Argentina or Venezuela, have massive inflation. Countries with strong institutions, like Australia or Sweden, are stable. Baronia sits exactly where you'd expect: high inflation and no independence. Fixing this would be step one. Second is rule of law. This is honestly the most important one. Without it, nothing else works. If lenders can't recover their money through the courts, they won't lend. If investors think contracts can be overridden by politics, they won't invest long term. And again, the data backs this. Countries with strong rule of law, like Singapore or Denmark, have way higher income levels than those without it. So Baronia needs an independent judiciary, enforceable contracts, and secure property rights. These aren't optional. They're the foundations of an entire system. Third, a lender of last resort. Baronia's banking system is fragile. Even a healthy bank can collapse overnight if people panic and withdraw their money. This is where the central bank comes in, but only if it's independent. It needs to step in during crisis and provide liquidity to stop panic from spreading. We've seen this work historically, from early UK banking crisis all the way through the GFC and COVID. Without that backstop, one crisis can take down the whole system. The fourth step is fiscal discipline and transparency. This is where Baronia really went wrong. The government relied on the central bank to finance spending, which basically means printing money. And as we know, that leads directly to inflation. It's a pretty simple chain. Government borrowing, it leads to money printing, leads to more money in the economy, which leads to a higher inflation. The fix is also simple: fund spending through taxes and bonds, not printing money, and make budgets transparent and publicly audited so this can't happen again. Now the key point is sequencing. You can't just do everything at once randomly. These reforms need to happen in the right order. First, you got to establish a central bank independence and the financial regulator. At the same time, You start strengthening the legal system, contracts, courts, and property rights. Then you move to fixing fiscal policy, cutting deficits, and ending money printing. Only after all of this is achieved and stable, it makes sense to build capital markets like bond markets or stock exchanges. To wrap up, Baronia's crisis is really a crisis of trust. People don't trust the currency, the system, or the institutions behind it. And trust isn't rebuilt through announcement, it's rebuilt through credible systems that can't just be changed overnight. So the solution isn't just one reform, it's a combination. Central bank independence, a strong financial regulator, rule of law, and fiscal discipline, all working together. That's how Baronia restores confidence, stabilizes the economy, and actually sets itself up for long-term growth. Thank you, and we hope you enjoyed our presentation, and we hope that we were able to answer the question and meet all the criteria needed.